One of the most common questions I get from you is when should you sell a stock? And this is clearly one of the most common questions that investors ask themselves. So I'll try to answer as best as I can. This is not an easy question, unfortunately, and I wish I could give you an anonymous answer. For example, that you should sell when a stock has fallen by 20% or when it's up by 50%. But there's no such specific answer, unfortunately. It all really depends on why you bought a stock in the first place and on your specific situation. There are three types of different investors in the stock market, or three types of sellers, if you will. One is basing their decisions on fundamental analysis. This is when you look at the fundamentals of a company, such as key figures like the P/E ratio, for example. The other is basing their decisions on technical analysis. This is when you go in technically and analyze patterns in the stock's price data. And the third seller type acts more randomly. And what I mean by the seller acting more randomly is they're acting out of other reasons that are not related to the stock market or the specific stock. They're just acting regardless of how things go for the stock. For example, that they need the money right now for something else. Something in their situations may have changed. Maybe they have achieved their saving goals and they want to use their money to buy a house, for example, or a car, or whatever they want to use their money for. Yeah, there are several different reasons to sell that are not directly linked to how things go for a certain stock or how a certain stock performs right now. But if we ignore this person who sells a little bit more randomly, there are some other reasons why investors choose to sell, and this we will take a closer look at now. First of all, there might be reasons to sell if something has changed in your situation. You may not need the money right now, but you plan to use them in less than 10 years, and then you need to consider whether you have the right level of risk, and maybe sell some of your shares at least, depending on how soon you plan to use your money. Then there are other reasons that are more related to the stock in the company. So the first reasons are when a stock has performed well. If you invest in a stock according to fundamental analysis, one reason for selling may be that the stock has reached its right value or its intrinsic value. If you bought a stock based on fundamental analysis, you have often set the right value for what you think that the stock is actually worth. If we take a simple example, imagine that someone bought a stock because it had a low P/E ratio. A low P/E ratio compared to other companies in the same industry may indicate that the stock is undervalued. And this is what we want to find with the fundamental analysis, undervalued stocks. So say that someone has bought a stock with a low P/E ratio. The P/E ratio for this stock may be 8, while others in the same industry have a P/E ratio of around 14. Then you may want to sell the stock when the price has risen so that the P/E ratio is closer to the industry average of 14 and is no longer considered undervalued. Now, I only made these values up, so don't follow these numbers exactly and don't just buy stocks only based on the P/E ratio either. Through fundamental analysis, you can use different methods to compare stocks with each other, and there are also different methods to calculate what the correct value or the intrinsic value of a stock should be. And then you compare this to the share price. So if the share price is lower than this value, you should absolutely buy the stock and then keep it until it's reached its intrinsic value, because you don't want to own stocks that are overvalued. So this is when many sell. Then there are other parts of the fundamental analysis that can also help determine when to sell a certain stock. It's not only the actual value of the stock that you want to look at, but you may also want to look at what's going on in the world. For example, there might be something happening that might make a specific stock fall. And I've made several videos on this before, but briefly. For example, there's some stocks called cyclical stocks, which actually performs better or worse depending on where in the business cycle we are. In light of this, then many want to sell these stocks that are very dependent on the business cycle if we're entering a recession. These are manufacturing stocks, for example, or companies that sell more of a luxury product, or something that we buy less of as a consumer if we have less money. If we're going into a recession, many people sell these cyclical stocks and buy more defensive stocks that are not so sensitive to changes in the economy. These are companies that produce things that are always needed, regardless of whether we have more or less money at the moment. And this is, of course, items such as food and medicines, for example. Then there are other macroeconomic indicators as well that also can affect companies differently. And this might be interest rates, for example, or where the inflation is at. So try to consider how the companies that you've bought shares in will be affected by different macroeconomic changes and keep an eye on these factors if they can affect them. The industry a company is acting in will also play a big role. For example, you may want to sell because you no longer believe in the industry or a product that a company sells. It may be a product or industry that is in a decline and that has been replaced by new products, where you no longer believe that there is any potential for the company and the stock. And for this reason, you may want to sell as well. Then we have those investors that use technical analysis. And in technical analysis, there are also a whole range of selling signals that indicate when you should sell a stock according to different criteria. I myself, I'm not super into technical analysis, mostly because the research actually says that there is not so much fundamentals behind this method, but we can talk about this another time. Anyway, one of the simplest strategies, perhaps in technical analysis, is to look at when the stock price is at in relation to its moving average. This is what is called MA. So then we can look at the moving average over different time periods, usually 20, 50 or 200 days. So a sell signal for a person who invests in stocks according to technical analysis may, for example, be that the stock price crosses one of these moving averages on its way down. Then there are yet other reasons to sell that don't completely fall within these two analysis methods or that are used in combination with these strategies. One reason for selling may be that you want to sell according to your investment strategy, not because, for example, you've seen these technical signs or the fundamentals behind the company has changed, but it may also be because you have an investment strategy where you say want to own 20 stocks in a portfolio and then you want to own equal proportions of each stock in your portfolio. So each stock would make up about 5% of the total portfolio. If one of the stocks then has risen more than the others, so this stock suddenly may represent 10% of the portfolio, then you may want to sell some of it so that you level out your portfolio again, so that all stocks again make up 5%. So this may be one of the reasons to sell a stock, and that leads you to reduce your risk because you don't want all of your money in a single stock. This is a very risky move. A stock that has gone up quite fast for no apparent reason, such as a good PM with some info that obviously would raise the price. In my experience, these stocks also tend to go down quite quickly again. Maybe not all the way down to where they started, but a bit at least, especially when you see this so-called exponential development of the price. If you own a stock where the price has risen more by speculation than by the fundamentals or maybe technical indicators, it might be time to consider whether the current price is actually reasonable and sustainable. Another reason, regardless of investment strategy, may be that you have actually found a better stock, a better investment opportunity, and when you think you can get a better return, and then this is a good reason to sell. And if you've been following my channel for a while, you probably know that I mostly invest in index funds, but I also have some individual stocks. I would say that about 1/6 of my invested capital in the stock market is in individual stocks right now. And I buy stocks according to a very specific strategies, where I keep the stocks either 1 year or a quarter and then I evaluate again. So I don't really sell stocks because they're performing well or not that well, but I sell them instead because there is something else that, according to the indicators I use to pick stocks, should perform better. And this has gone pretty well so far, so I'm pretty happy with my strategies right now. There's so many different investment strategies that it's difficult to cover all events that you might want to sell in this video. But I want to point out again that it's very good to at least have a strategy, opposed to just buying stocks randomly based on your feelings. Then it will be less random in all the buying and selling that you do. Even if no strategy will always be the best or the most optimal, I think you will do better if you use a proven strategy than just buying and selling based on how you feel right now for a stock. But what should you do if a stock simply is not performing well, even though your investment strategy indicates that this was a good buy? Most of the reasons we have talked about so far have been when you want to sell a stock that has gone up, but you might of course also want to sell a stock that has simply underperformed or produced a negative return. It's not gone up enough compared to the index maybe, or it has simply gone down instead. The first thing you should look at is how the stock market is doing in general. What is the index returning? If the whole stock market has gone down, then it's not surprising if your stock is also going down. This can happen for other reasons that are not directly related to the company, but the stock market in general might be shaky. Then there is no reason to sell if you still believe in the company. But even if you believe in the company and bought it because you thought, for example, that you had found a good undervalued stock, the stock may not perform anyway as you thought. There can be very good fundamentals behind the stock or technical signals as well, but it simply doesn't go up. Sometimes you have to wait very long for what you've seen in your analysis to simply be fulfilled and seen by other investors too, because that's what moves the price. And if you think you have waited too long, it's usually recommended by banks and other institutions that if a stock has underperformed or had 3 bad years in a row, then you can review your investment decision and try to figure out what's the reason for this and maybe sell because of this. Then there are also some warning signs from companies that you can keep an eye out for, which signals that it might be time to sell. It could be, for example, if a key person such as the CEO suddenly leaves the company for one reason or another. This often signals that everything is not entirely as it should in the company. Other signals can be when reports are postponed for some reason. It sometimes happens that someone in a leading position is prosecuted for a crime, or that people in leading positions sell off large parts of their holdings. And this signals that everything is not as it should in the company, and that these people do not believe that the stock of the company has a good future. And this has actually turned out to be good signals that signal worse stock returns for the future. If any of this happens to a stock that you own, you should probably consider at least looking more carefully into what's going on with the company and whether it's time to sell. What future prospects does such a company even have? And this can also be applied to funds. If you look at fund managers, for example. If a fund that you like changes managers, it may happen that the future returns also will change because of this. If the new manager doesn't invest exactly as the old would do, which is pretty unlikely. If you want to protect yourself a bit from downturns or don't miss to sell in sudden upturns, then you can use something called a stop loss. When you use a stop loss, you can set a certain value or a certain percentage as a kind of protection level. And if the share price reaches this value, it should be sold automatically. Then this stop loss kicks in and then the shares are put up for sale at the price you've chosen. This is not quite a 100% protection because sometimes the price moves very quickly, for example. And even if the stop loss then kicks in and puts your shares up for sale, the sale price that you've chosen may already have been passed. Then no one wants to buy your shares, of course, even if the stop loss has kicked in. And sometimes this stop loss level will also be passed during the night. The stock may close at a price above your stop loss level, but then the stock market opens again and the price is already below your stop loss level. And even as the shares then are put up for sale, no one wants to buy them if they are priced higher than the current trading price right now. Did you buy stocks without doing an analysis and now you're wondering when to sell? Well, don't worry, you can simply choose a method right now and start doing your analysis. So what are you waiting for? Get started! The video is over now, and make sure to let me know how it went down below. And I'll see you all next time.